Hey, welcome everybody to the 40 Finance channel. My name's Jeff Beers. Today we're going to look at the top 5 semiconductor stocks by market cap here in the USA. So just USA semiconductor stocks. We're going to analyze where these guys are trading at as a group, compare them individually, and talk about which ones offer the best growth prospects in total stock returns over the next few years for long-term investors. Reminder as always that my stock picks and projections, they're just my opinion for your entertainment. Please make sure you do your own research and due diligence before investing in any stock. And of course, if you like stock market analysis and personal finance videos, then please give this video a like and subscribe to the 40 Finance channel. Thank you to everyone who has supported the channel. All right, let's set up some analysis parameters for this semiconductor stock review. We're going to do basically a look at growth versus value for the top USA semiconductor stocks. We're going to evaluate the current entry points for each stock and talk about, is this a deal right now today for new investors? And we're going to identify the best growth prospects out of this group of 5 for the next 3 years. And then, of course, we always want to consider total stock returns for the long term. That includes, growth prospects, dividends, entry point, all that stuff put together. So we'll look at the metrics for each and try to see which one, if you had to buy today, which one might be the best one to start a position in if you're a new investor. All right, so in order to get to our top 5, I laid out, these are the largest semiconductor companies by market cap. I'm excluding TSMC, which is actually a stock that I own and I like very much, but their home country is in Taiwan. ASML, they're in the Netherlands. So to bring some uniformity to the way we're going to look at it, we're just going to focus on companies that bank revenue in US dollars. That gives us Nvidia at the top, Intel, Broadcom, Qualcomm, AMD. Focusing on these stocks in the USA gives us a little bit of benefit because everything's the same in terms of currency exchange and all that. So that's why I chose to do it this way. All right, first stock on our list is Nvidia. And you can see that this is a year-to-date chart. Nvidia, no surprise, has had a great run. Hard for me to tell from here, but it definitely doubled up, if not 3x'd this year or approaching that world. Trading right now with a PE of 86.79, EPS of $6.12, and on today's price, we have a dividend of 0.12%. Looking up at the forward PE for Nvidia, it's coming down based on future earnings to 47, which is always what you want to see. And I did a little research for all these stocks over the past 3 years, and Nvidia's average forward PE is 37. So it's definitely trading at a little bit of an escalated price right now, but not as bad as some other stocks that you'll see in the market. But just know that you will be paying up. Obviously, as long-term investors, that doesn't matter nearly as much. We just want to make sure that we're not grossly overpaying. And if we are overpaying, you certainly have to compensate significantly with a strong growth rate. And speaking of growth rates, here's Nvidia's projected growth rates over the next quarters and years. This year, they're going to end up at a 68% growth rate in terms of revenue. Next year, that comes down quite a bit to 20%, which really isn't a surprise because the pandemic drove so many sales for the PC industry. It's really unbelievable. In fact, they're still dealing with a shortage. So most analysts don't think that the 68% clip is going to continue. I tend to agree. Drop into around 20% growth next year and a 5-year per year average as of today projected at 21.47%. Looking at the TipRanks dashboard to see what the best performing analysts are saying about Nvidia, you pretty much have buys across the board. One analyst did come out 3 days ago with a sort of negative view or a hold, if you will, on Nvidia. And that could just be someone saying like, hey, the price has run up, the company's good. That's what a hold rating is. They're just basically recommending not to buy it today because the price is inflated, essentially. But all the other analysts have anywhere between, a 3% upside all the way up to, what was that, 31.8% upside. This is a projection for the next 12 months, is how most analysts work, or next fiscal year, if you will. So there's still some room to run for Nvidia if you are buying into what most analysts are saying. All right, next one on the board is Intel, which has sort of had a really rough year, as you can see from the year-to-date charts, as sales have sort of slipped for them. Comes at a bad time, mostly because the rest of the industry is up significantly. And there's a lot of whispers about Intel right now. So anytime I see that and I see a chart like this, I say, hey, wait a second. This is the second largest U.S. semiconductor stock by market cap, let alone sales and revenue. Is there something here to jump in? When you look at the numbers, the P ratio is under 10. So if you think about the difference between Nvidia for a second, I believe that their EPS was in the $6 range. Intel's coming in at $5 range, but it's only trading at 9.29 times earnings right now. You look ahead on the forward PE and it only jumps to 10. Their average over the past few years comes in around 13. So I wouldn't say that the price is necessarily distressed completely based on historical forward PEs, but it is definitely trading much cheaper than Nvidia. And you also get this 2.78% dividend on today's price. All right, so these growth estimates here for Intel kind of tell the story of why it's trading much cheaper. We remember that Nvidia had a growth rate around 21% over the next 5 years. You can see Intel has struggled this year. They are projected to struggle even more next year, not to the same degree, but minus 6.6%. But then over the next 5 years, you have about an 8% growth rate. That is down from the 20% or so that they were doing in the past 5 years, but you do also get that dividend. So you're giving up on a percentage basis, if you compare to Nvidia, you're going from a 21% annual growth rate over the next 5 years. You're dropping all the way down to slightly under 8%, but you do also get the dividend and you're buying the stock at much less of a multiple. So between the first two, I would probably still side with Nvidia as being the better deal, but the better deal is going to take perhaps more years to pay off, whereas your Intel price today, you're not going to get as much growth, but if there were a crash, so to speak, Intel would likely drop much less than Nvidia would. And that is because it trades much more closely to the EPS numbers that it is putting up. All right, on the TipRanks side for Intel, you can see it's quite a mixed bag. You do have a couple buys, I would say mostly holds and 3 sells. All of these have come in over the past couple months. And it's a mixed bag on upside too, right? You have as high as 26.42%, and the low is taking another 15% off of today's price. So the question kind of becomes with Intel, and you know that the growth projection for next year is negative, is today the time to buy? Or do you just wait for another round of bad news, get in even lower, or manage down on your cost basis and then ride it out with the dividend and the fact that eventually they'll hop back on their feet, maybe not in a monster growth mode, but certainly turn the ship around and start posting, plus 8% growth. All right, next on the board, we have Broadcom. And you can see that Broadcom has had a strong year, very similar to Nvidia. If you look at the 52-week range, they've basically, 3x'd where they sat when the year started. You got the P ratio of 68 today, EPS right in the neighborhood of $6. And on their current price, you get a 3.31% dividend, which I believe is the top one that we've seen so far. Then you look at the top for the forward PE projection of 16. Their 3-year average has been right around 13. So not grossly overinflated for the future growth here. Taking a look at Broadcom's growth projections, looks like they will end the year about 17% up. Next year, that growth is slowing, just like it was for Nvidia. And then over a 5-year stretch, you're coming in projected around 8%. That was very similar to Intel, but the difference is between these two companies is that Broadcom looks to have more of a positive runway for the next 12 months, and thus it could be an alternative play to Intel while getting a steeper dividend. Now on the TipRanks side for Broadcom, it's pretty much a no-brainer for these analysts anyway. It's a buy across the board. You can see though, despite the buy ratings, there's not a huge ton of upside that many analysts are calling for. We see the 12.7% from one analyst, and if I had to eyeball the low bar, it looks like it's right here at 2.4%. So again, it was a good year for Broadcom. They've had a good several years, but there is that sentiment that perhaps their growth is going to slow down to single digits over the next several years. So you have to factor in the dividend, and you have to see if it's a good choice for you. All right, next on the board is Qualcomm. And Qualcomm, very similar story to some of the other ones that we've seen as far as the trajectory of the year-to-date chart. And on the 52-week range, you've got about a 3x in there, a little shy of a 3x. P ratio today at 32.62, EPS of 4.52, and a dividend of 1.76 on today's price. When we look ahead to forward PEs, today you sit at 21. The average is 18.5. And I think with Qualcomm here, you're going to see that you kind of get this like best of both worlds in terms of value and growth rate. So this is a very interesting stock to keep on your watch list, potentially too, if we see another dip this year into winter. This is one that I'm definitely considering. All right, so I mentioned the growth rates with Qualcomm, and you can see that, the current year, almost up 70%. That is spectacular. Next year, you're still in double digits at 11.2. But then when we talk about the next 5 years, you've got almost 25% per year on this one. So you've got plus 20% growth, a solid dividend, and a relatively fair valuation compared to some of the other top growers. So Qualcomm's one that I kind of like the way that it's shaping out from a fundamentals perspective. After you get past fundamentals, you then, of course, have to dig into business plans and everything. But this one caught my eye. All right, on the TipRanks side of things, we have mostly buys, a couple holds in here. And upside downside, you kind of get a 5%, or wait, there's a 1% on the low side of things. But you do have a couple analysts in the plus 20s and in the plus teens, if you will. So I would say with Qualcomm, for me, it ticks a lot of boxes. There's still some uncertainty on these holds that I would want to read into a little bit more and figure out, why are people not fully aligned like they are with Nvidia. So that would just take some more research, but from a first glance, there is definitely opportunity here. All right, next up is probably one of the hottest stocks of the year. I would say them and Nvidia have certainly been the two most talked about semiconductor stocks. If you go to a 52-week range, you can see that they basically 3x'd from the beginning of January. P ratio today of 129. EPS, this is probably the smallest EPS we've seen today by a substantial margin. Most of the chip stocks we see are coming in that $4 to $7 EPS range. AMD is obviously much more of a growth story. So they're still building out their EPS, and with that you get no dividend with AMD. And when we look at the forward PE, it's trading a little bit higher than some of the others. You got a 53 today. The average over the past few years has been around 44. So obviously when you get a growth stock, the multiples are going to be higher. I don't necessarily think that it's cause for concern, but I do think that when I look at numbers like this, I say, hey, if this is what I'm interested in, I'm probably going to at least wait for a red day to take a couple percentage points off. But with a growth stock like this, if you're in it for the long term, maybe you start a position and average down. There's so many different ways to do it. All right, and when I say growth stock with AMD, here's what we're talking about, right? Current year, they're up 92% on their revenue. Next year, again, another dip, mostly because PC sales and accessories are going to come back a little bit down to earth. And you got a 48, let's just call it 50% growth rate for next year, which is obviously outstanding. And AMD is leading the way on the 5-year growth average of 38% per year. So no surprise that you're going to pay a little bit of a premium for AMD. I think the one risk side of it, if you will, is that if there is a crash or a pullback, because the multiple is so much higher than some of its peers, that you may see AMD dip more than the average if we do have a pullback. But in the long term, you have to feel good about this. It just depends what your portfolio is built like. How much do you appreciate dividends and how much do you appreciate steady growth with limited risk? If you do look at valuations and think about what you're paying for earnings today, like I do, AMD is not necessarily a slam dunk, but it's hard to argue the direction that they're moving in. All right, on the TipRanks side of things, we got 2 holds with a couple downsides, -6% and -21%, but the vast majority of the analysts are in the buy category, and I think our range is about +25%. One coming in at +4%. So most analysts are saying, hey, over the next 12 months, you got room to run. Given AMD's growth rates that we saw on the slide before, I tend to agree with them. I think that the big key will be your entry point with AMD. If you want to maximize your returns over a 1-year period, you're probably wise to try to get it at a discount. Not because AMD is a bad company, but just because the market has been up substantially this year. I think that there will be at least a pullback heading into, mid-January or the inauguration. It just feels like there's nowhere else to go but down, at least on a dip level. And that's where I would think about AMD. All right, so that's a full look at the top 5 semiconductor stocks here in the US. Of the names that were on there, I think Nvidia and Qualcomm are the ones that interest me the most. I'm not sure that I would buy either of those today because I do not have an existing position. I do have exposure to most of these names through the ETFs in my retirement account. From a standalone stock perspective, though, I do own Taiwan Semiconductor, so I'm really happy with that. Nvidia and Qualcomm are potential candidates. I would probably look for a dip, as I mentioned. And for me, I really have to think about how many chip stocks I want to own as standalones, only because this industry does go into cycles. I think next year's cycle is very positive. It'll be down from the year before, so it'll be interesting from a comp perspective when earnings come out. We saw some of those charts of what happened this year and what the projections are for next year. So what we may be able to see in the chip sector is with next year not being as good as this year, you might be able to take advantage of situations where earnings calls, show a negative comp, right? And things come out kind of negative, even though they're awesome, you're just going against a historical best. That could be the time to jump in if you really like one of these names. I definitely wouldn't buy any of these names on the hottest day of the market and think that you're going to miss out, because they are on fire right now. And like I said before, I feel like there's more potential for downside, temporary, short-term price downside. And if so, you might get yourself a good deal. All right, guys, hope you enjoyed this look at semiconductor companies. Please give me a like and subscribe if you did. We'll see you on the next video.